before we construct this balance sheet, we need to make certain adjustments. I need to show you how companies actually massage their income statement and make things rosier than it is. Let's say we are calculating our cost of goods sold. We can either overstate or understate it. In our initial case for the income statement, we actually overstated it. Remember, we made 12 cupcakes, but we sold 10. But we ended up using for the cost of goods sold, we ended up using all the sugar for which we used to calculate to make 12 cakes for the cost of 10 cakes. So also the flour for making 12 cupcakes for calculating it as a cost for the 10 cupcakes which we sold. So in order to make this adjustment, we now say 2 cupcakes which are remaining divided by 12 for all the total number that we made, multiplied by the flour used, 30 cents plus 25 cents of sugar. That is going to give you 0.09, let's just say 25 cents. Let's approximate it to be 10 cents. So we have those extra 2 that we put on top the 10 that we sold, increased the cost of goods sold by 10 cents. We adjust for the income tax. Remember, we paid income tax, so it then means that our net income is going to increase by 10 cents, but we are going to pay tax on this 10 cents, and that is going to give us cost of goods sold adjustment will increase the net income by 10 cents multiplied by 1 minus 0.19. So that's going to give us roughly 8 cents. It means that our initial net profit of $2.51 would increase by 8 cents. So that now gives you $2.58. Also, remember that we introduced depreciation at the cash flow stage. So it also means that this value did not have depreciation in the initial situation. So a company can choose to massage its net profit by changing the values of depreciation, assumptions of depreciation, or the principles for which it is using for depreciation. So if we then choose to recognize depreciation in the income statement, depreciation is equal to $1. If we make these adjustments on the net profit, it's going to actually decrease our net profit. For us to know the amount for which we are going to decrease our net profit by, we're going to have something like this. $1 multiplied by 1 minus our income tax, which is going to give us 81 cents, for which this income statement is going to be depreciated by. Remember, there is what you call tax sheet. So we are just trying to take cognizance of the tax sheet that is going to happen when we depreciate this. We can't just deduct $1 from this amount. No, we are going to account for the tax sheet. So this is a tax sheet that is provided. So if you increase that, it's going to give you 258 minus 0.81. So that gives you 177. That was supposed to be our net profit. So for the asset side, I've written this out. The cash we are going to have when we have adjusted the net profit. Remember, we are using an adjusted net profit of 177 through the cash flow. When we run it through the cash flow, 177 instead of 251, which we had previously as net profit, we are going to have a new cash of 568. Is what you have when you take the cash on the cash flow, which you have gone through before, along with the leftover of the $3.50 from your initial capital of $10. So now we have receivables of $3, which is the amount people are owing to us for the cupcakes they bought but have not paid for yet. Inventory is a bit longer than that. We are going to calculate for 70 cents of flour left initially, and the new $1 flour which we bought. We are going to calculate for the 25 cents of sugar that is left. 2 cupcakes would be valued a bit differently because this is finished product. So in your calculation, you are going to have those 2 cupcakes now valued at 54 cents. How did we arrive at 54 cents? We took about 9 cents for the raw materials for which you have used in producing the 2 cakes. We have labor for producing the 2 cakes, which is 2 divided by 10 multiplied by $1.25, and the machinery which would be used in making these 2 cupcakes, which is 2 all over 10 divided by $1 of depreciation. So this, if you calculate your inventory will now be valued at roughly $2.49. Then we have prepaid expenses. So prepaid expenses, remember we did a maintenance in our cash flow whereby we're trying to maintain the equipment for which we were using. So we at that point we had not recognized the expenses in our income statement, so we have them as prepaid. So we have 80 cents of prepaid expenses. Then the non-current asset, which is the equipment, is $5, for which we bought at the very beginning, less the $1 for depreciation, which leaves the old equipment valued at $4, plus $2 of new equipment. So it then means that our equipment total is going to be $6. When you put all this together, you are going to have a grand total of this 868. That is going to give you $17.94. $0.07. That is your total asset. Now we are going to move on to our liabilities. Here, very quickly, you have your equity. So let's say our equity, which we started with, was $10 original. So original equity, which is called your paid-in capital. So paid-in capital, we had $10. Then also the profit from the income statement then swings right in here. And if we don't pay, what normally happens is if we don't pay any dividends, we put all of that under your equity as retained capital. But if we pay dividends, let's assume we pay dividends. So if we pay dividends, we subtract the dividends from the net income, and whatever is left we plug into the equity side of things. But in this case, we did not pay any dividend. We are not a company that borrows money to pay dividend. There are some companies that do that, so I'm just trying to tell you, right? So now if we say retained earnings, we say $1.77. Then we come to the proper liability side of things. We have our current liability, which is only the payables, 20 cents. The next one is loan from John. Which is equals to $6. So what we then do here is to try and calculate our liability and our equity together, and then we'll have and try and see if it balances with this side. So our total liability, normal liability here, is roughly, that's total liability, is roughly $6.20. So if we have $6.20, our shareholder, this total becomes shareholders equity. Shareholders equity becomes $11.77. So if you add this to that, it gives you $17.97. So this here balances right here. So at that point in time, when you went into the room, when you went into the company and took an assessment of what you have and what you owe, this was the picture that this was the financial picture that you wrote down. Ladies and gentlemen, you can see from here that buying shares is not just about name. It's about digging deep. Forget the name of that company. You need to dig deep and understand the numbers they are presenting. Mind you, this is very simple form. Beyond this, you would see all sorts. You will see goodwill being put at the asset side. There are different kinds of goodwill at cost. That's when the company acquires another company beyond the value of the um, net equity. So you you recognize that cost right here. Then there is another goodwill called the going concern goodwill that you don't put here in the company. So the going concern goodwill has to do with the company itself, what it feels it's worth. Gone are the days whereby a company will just throw in a value for their going concern goodwill. These days, it doesn't happen. I understand back in the days, in the early 30s, or anyway, way back, it used to happen. Companies would just throw in the value as their going concern value to increase their asset. It doesn't happen like that these days. This whole process is very exciting. It excites me when I have to dig in deep and understand a company. And it's a journey I really want you to share with me. Thank you for watching and have a lovely day.